Hello, everyone, and welcome to another episode of the Imperfect CPA. This is your host, Eric McGlothen here, and I'm happy that you all are joining me on today. Thank you all for all of your support over the past several weeks. It really encourages me, and I appreciate all the questions. I'm glad to hear that you all are getting something out of this as we together learn how to make money our employee. So on today, we've been talking about for the past several weeks, and we'll continue until we get through all the Seven Cures for a Lean Purse, which is in the book, The Richest Man in Babylon by George S. Clason. That's really what we're walking through today because the elements of my book, Make Money Your Employee, some of those tie in with that book. And I just think it's something important to know. I've been reading this book over and over again very recently. I'd read it a while ago before, but I'm really working to implement these principles into my own financial life so I too can continue to grow my wealth. That's why I wrote this book, Make Money Your Employee, because it talks a little bit about my journey in learning to make money work for me. And my hope for you all today that are in the audience, those that are listening to the podcast, to the broadcast, is that you will be encouraged, if you have not already started making money work for you. And if you already have, that you'll get some nuggets to help you further learn how to make your money really work for you as an employee. So today we're going to talk about guarding thy treasure from losses. I know this old English kind of, or I know you're gonna say old English. So what this ancient language may be, interesting and throwing us off, but the principles that are in this book are true, and I really enjoy them. I think they're right on, and I think they're important principles for us to know. So we're gonna just jump, into this so we can really talk through like how we're gonna protect what we got, because that's really the important thing, right? We might have money, finances, assets already in our hand, but we need to make sure, how do we keep those, right? And as we're generating more wealth from our investments, how do we make sure that we don't lose them as much as we can within our hands, protect those from being lost? So hopefully you can see these pictures up on the screen. I put together a few slides today to make sure that we kind of stay on point with these, and also just to help with note taking. Every broadcast, every podcast won't have notes like this, but I'm trying to make sure that we just observe some points and make sure that we are all instructed together. So what we're going to talk about today is what? Protecting what's in our hand, protecting what's coming into our hand, avoiding get-rich-quick schemes, which is important, having an investment philosophy, managing risk, dealing with internal control and fraud prevention, tax planning and compliance, asset protection, managing cash flow, and seeking counsel. It's actually going to move a little bit faster than what it seems like in these slides, so don't worry. But I think these are important points to address because, again, we work hard. I know you work hard. I work hard for my money. I work hard for the things that I have, and I really want, as much as possible, guard against, losing those things. So listen, these are, I like movies that are about business and money and finances. So Boiler Room was probably one of my favorites, with Vin Diesel and Nia Long and others that were in that movie. I just think it's a great movie, but there are really some lessons to learn. We may not get into those lessons necessarily in this broadcast today, but I thought that would be good just to kind of talk through situations and movies that highlighted instances in which people lost their money. In Boiler Room, right, they were selling basically, and investments, fake investments, or just being really aggressive in their sales taxes. And basically the people who invested, trusted the advisors and put their money into these investments, they lost their money. And it was basically the Boiler Room was because they were just working to turn over, get as many investors in as possible, get as much money as possible so they could try to fill their own pockets without even caring about the investors. Another movie is Margin Call, which I really like. I've watched this movie several times, and I have to keep watching it because it has some complexities to it in terms of the types of financial products that they were using, and how basically because of some calculations, like it was taking like the whole firm down, very ruthless. uh, uh, it The way they did things to make sure that they could protect the firm as much as possible. But again, these movies become instructive in terms of how, if you're not careful, if you don't, make sure that you get wise counsel. One, make sure that you're not greedy about how much you invest. If you don't make sure that you have a philosophy about what things you're going to invest in and what not, and if you don't keep your eye on the ball, then unfortunate things can happen. And then there's, of course, Wall Street. I know there was another Wall Street after this, but I really like this one very much. And again, it really, to me, these movies also start to emphasize how in our own nature, because all of us, I think for the most part, a lot of us want to be wealthy. A lot of us, while not coveting money, definitely want to have some money in our pockets. These movies really become instructive about how, if we let greed get in the way and greed really be our driving force behind how we move and getting money in our pocket, it really can put us in a position where we're positioned to lose at some point. So I would say, if nothing else, if you don't get anything out of we talk about today, is guard against greed. Guard against trying to get money in your pocket too fast. Slow money is better than no money, and is typically better than fast money. So that's what I would say as it relates to that. So listen, so here's the excerpt, from the book, and I'm just going to read the excerpt because I think it's important to read it as it is, and it really becomes instructive for what we're talking about today. And it goes, the excerpt is, gold in a man's purse must be guarded with firmness, else it be lost. Is it wise to be intrigued by larger earnings when thy principal may be lost? I say not. The penalty of risk is probable loss. Study carefully before parting with thy treasure. Each assurance that it may be safely reclaimed. Be not misled by thine own romantic desires to make wealth rapidly. And that's really what we're talking about with greed, is we want to be sober-minded. We want to be sober-minded in how we deal with the money that's in our hands, the assets that we have, the business that we have, the investments that we have. Sober because we want to realize that at any time, those things can be lost. At any time, something can change that could put us in a position where there's a risk of loss. So you want to do the things that you can to guard against that. And so, as I say, the first point is protect what's in your hand, right? So it's so interesting. A couple of days ago, right, somebody hit me up on Messenger, and they just out of the blue, right? I'm thinking they hit me up on Messenger. Typically, when people hit me up on Messenger, say, "Hey, give me a call." Typically, it's, I'm a CPA, so they're saying, "Hey, I need some tax work," or "I got a tax issue," or "I need to get my books done." This person hits me up, and after just saying, "Hello, how are you doing?" they said, "I need to borrow some money." And I'm like, "Wait, who are you?" Like, what? Like, it was just so crazy to me. Of course I told them no. But number one, it caught me off guard. Number two is it made me realize, and I'm sure, where it may not just be somebody out the blue, we all have dealt with situations where there are individuals that will try to take what's in our hands. Whether it's money, investments, typically it's money, right? Because people want to have you part with the dollars that are in your pocket to help them. And they may do it via a loan. They may do it via a get-rich-quick scheme, or whatever else they're trying to do to get you to part with your money. So you want to be very mindful about who and what you're putting your money with. Don't be so quick to come up off your money. What my wife and I have recently adopted, just in general, is to take a beat, take 24 hours and think about something before just saying yes right away, to give yourself time to be sober and think about, is that a good decision? Is that a good move? So I talked about avoid get-rich-quick schemes, right? And there's a lot of them out there. If you watch American Greed, right, They talk about all sorts of situations, things dealing with real estate, putting money into, real estate that was never either acquired or never developed once the person got the property, or that too much debt was overloaded onto the property so they could never make money off of the property. I mean, there's just all sorts of things that are out there to help you part with your money in your retirement account, money in your bank account, money in your business. I've been a victim of those a couple of times. So I say now I'm like very cautious, very thoughtful, because I'm older now. I'm not as young now, so I don't have as much time to recover from losses. I've also got a family. I've got a wife. I've got kids, so I can't afford to be making crazy mistakes that can put everybody at risk. But you too should be cautious about what business and what you put your money into. And before I go to this next slide, I tell you right now, and I think I talked about this before, I'm dealing with a current situation with a client that we've acquired, where basically this client, well, not that we're taking on the client now because we're helping as kind of the accounting firm that's taking over from the people who were doing wrong with the business and with the money. Basically, this person who used to own the company basically got people to put money into, an investment that didn't exist. They were actually getting them to put money into loans related to houses that they didn't own. And these people are now just out, and that's going to be unfortunate. But it just lets you know that there's others out there that are unscrupulous, that just want to make their money and don't even care anything about you, what you lose, what you're putting at risk, that you trust them, none of that. So avoid get-rich-quick schemes. And then have an investment philosophy. Everyone that's out there in this audience should have a thought about what they're willing to invest in. What are your goals, right? What are you trying to accomplish and when? Are you a person that needs to make money, more short-term than long-term? What's your risk tolerance level? We talked about that a couple of episodes ago. Are you more risk tolerant? Are you more risk averse? I tend to be more risk tolerant, but I have clients that are more risk averse, some to the degree where they're not going to do hardly any investments. We talked about that before, that may not be a good thought process. But the important thing is to have a thought process, a philosophy, and then the other part of that is not just having it, but sticking to it, which means that if my philosophy is basically that I only invest in businesses or in real estate, and I don't do any stocks or bonds, then I've got to stick to that and make sure that if somebody tries to say, hey, you should invest in this particular company, like, no, my philosophy is I do these things. This is the goal that I'm trying to reach. This is how much money I'm trying to make in this period of time, and this is where I'm staying. Having those kind of guardrails and guidelines is what will start to help you prevent being distracted by the things that come on the left and the right in terms of what people are going to present to you. Because once people understand that you have some means or think that you have means, they're going to start to present opportunities to you. And so you need to be very mindful about understanding, does this fall within what I'm trying to do? Is it going to get me towards my goal? Among other things, among doing your own research and those kinds of things, you have to even know if it fits within your philosophy. The next one is being able to manage risk. So whether this is your investment portfolio, right? So if you're in your investment portfolio, right, typically every quarter or every 6 months, or at least once a year, right, you're typically going to meet with if you have an advisor, meet with your financial advisor. And if you don't have one, depending on the size of your portfolio, you may want to consider talking to one just to help you fill in the holes of what you don't know. And if you don't have, I do not want to get an investment advisor, then the thought process is I should at least be doing my own research, which is what you should do anyway. Do reading up on the companies that you're investing in, Make sure that you're following what's happening with that particular company if the investments are your thing. If you're doing real estate, understand what's happening in the real estate market, right? There's people that I actually have a lot of clients that hold real estate, that are landlords that rent out, but you need to understand what's happening in the real estate market, right? If your investments are in real estate, because you need to understand, interest rates on mortgages going up and down. How does that affect you? Does that mean that I need to raise my rental prices if I decide to refinance my property because I need to get some cash out and maybe have a higher, interest rate? Or I need to understand that if I'm buying and flipping, right, I need to really understand what this market is like, right? Because if it's a seller's, market, then yeah, buying and flipping may work out really well because you can turn your stuff around. But if it's a buyer's market, maybe it's going to be slower. Maybe people have more options, and so maybe your property won't turn, as fast. And I've had clients that have had to fire sell their properties when they finally finished all their work, did not get all the money that they were planning to get back from it because the market had shifted, or they hadn't done enough analysis or thought something was going to happen in a particular area that property would sell, but it didn't end up happening that way. So you got to make sure that you do risk assessment and also be able to think about, how do I manage that risk, right? What things am I going to do to help minimize the risk? So maybe I'm thinking, if I'm dealing in real estate, again, for example, maybe I hold on to a lot of cash that allows me to be able to maneuver and adjust if I've got to put out for a repair that maybe I didn't expect, or maybe it takes longer than normal to get a particular property rented out. And again, real estate is just an example of this, but you've got to do risk assessment and be able to manage risk no matter what business it's in. So you all saw last week, right, that I did a video for those of you that saw dealing with an RV. So my wife and I own an RV. We made that investment last, I think, September of last year was when we made that particular investment. And I call it an investment because that's what it was. I mean, yes, I like RVing. I love RVs. I've always loved RVs, and I'm excited that we have one now. But I didn't buy it just for personal usage. I really bought it as an opportunity to make money because I realized that there's a market out there for individuals who like to use RVs at tailgating, or they like to travel and want to go away for a week and go in the woods or whatever, and they want to take an RV with them. They want to have some luxury. They don't want to be in a tent, which would be me. I mean, I like camping, but I also enjoy being in an RV. So we realized there was a market, for that. So we decided that we were going to get into this RV, and also, candidly, as I mentioned in the video last week, every year since I think 2016, might have been longer than that, I've always rented out an RV for homecoming at Morehouse. Shout out to the house. So I've always rented out an RV every year, and when I would rent out an RV for homecoming, it would cost for 3 days at least $1,500, right? And so I was like, I'm tired of paying this fee when I feel like I could own an RV and be putting that money towards a monthly payment, and I could also be making some money off of it. So I made that turn and made that shift. But they're dealing with this topic of risk assessment, I also had to think about this, which is always the thing I usually think about biggest when acquiring assets like this. And that is, if nobody rents out that RV for an entire year, am I able to pay the note on that without significantly affecting my, way of living or cost of living and all those kinds of things? And so when I had that discussion with my wife, I was like, yeah, we can do this without changing up what we're doing. And that's how I went into that, so that I could guard against the risk of nobody wanting to rent out the RV, which in these past, 6 months or whatever, we've had 2 or 3 renters, I think, that have rented out for a week at a time. So when I videoed last week, that was someone who was renting out for a 4-day period up in Anderson, South Carolina. So I told you that we made about $1,500 on that for about 4 days. So that ended up paying the note on that RV, which is a good thing. Now I will say the side note of that is, and what's kind of cool about it, I shouldn't say it was cool, but it played out for me, was the person who rented the RV for 4 days. My son and I drove up to Anderson, South Carolina. They never showed up. They never showed up. We called them, we emailed them. The company who helped us rent out the RV contacted them. They never called back. They never texted back. They never emailed back. But guess what? Because of how the cancellation policy was set up, they'd already surpassed the cancellation period. So we got paid for a 4-day rental, even though the RV was rented out not even for a day. It was rented. We drove it up there, got up there about 3. By 9 o'clock, I think we were back back at the spot where I have the RV stored. So we made $1,400 for 6 hours of basically rental time and work. So it's a really good deal. But my point is, you got to guard against risk to make sure that you don't lose what you got. Remember, you got to protect what's in your hand. And you got to protect what's coming into your hand. So internal control. So this is really important with businesses. So if you have a business, if you're a business owner, you should really be very mindful of what controls you have set up in your business to make sure that you can guard against things like theft, things like fraud, things like embezzlement, right? Those things are really, really important. So you may be able to, you need to really evaluate that no matter whether it's a business or real estate or an investment, but it's particularly true, in business. Like, for example, right, in business, there's this I'm a CPA, right, of course. So there's a big thing about making sure that you have segregation of duties, right? So the same people that collect the money should not be the ones that are depositing the money, and definitely not the people who are paying out the money, because if they have their hands in too many things, it's so much easier for them to be able to, basically steal money, from your business. So the thought is, what controls you have in place to minimize that? Well, segregation of duties, for example, prevent that. So one person, may, collect the money, another person deposits the money. Or another control is dealing with bank reconciliations, right? So if you have a business, you have your bank account, and you're going through and you're reconciling your bank account against the general ledger. Some businesses may do that, some may not, but it's really important that you do that. That's another way of identifying money that may be leaving the business that you don't know about. A third control is management review, right? So manager oversight. What things are management of the company looking at? Or if you're the manager, right, or you're the owner, what are you looking at in your business to make sure that you understand what's happening in your business and can identify if there's things that are not right? Looking at trend analysis. Do you look at, the fluctuations in expenses or fluctuations in revenue, see things that are off? Those kinds of things you need to do in business, dealing to make sure that you can minimize the amount of fraud that happens in your business. If it's real estate, for example, in a situation that I described, right, where these individuals invested in real estate that they didn't own. They thought they were putting money into an investment that they owned, but they didn't. So maybe it would have been good for them to, 1, go visit the subject property, make sure the property existed. 2, make sure you look at some documents and make sure that your documents prove and tie to the fact that you have ownership in the property. Were those documents filed? There's just different things that you can do and look at to make sure that you can minimize fraud and make sure that you're protecting yourself against losses. Remember, that's the subject of today, is guarding your treasure against losses, whether it's real estate, a business, or investment. We want to make sure that we have things in place to prevent that. The next point deals with tax planning and compliance. I know it's such a boring subject, right? I know nobody likes taxes. Nobody likes paying the IRS. Nobody likes paying the state. I'm a CPA. I tend to find these things exciting in terms of helping people kind of minimize their tax situations and making sure that returns are filed properly. So to me, it's exciting. I realize to you all it's boring, but it's a necessary evil. The thing to think about, though, when you're dealing with your investments, and a good one that I would talk about is dealing with the 401ks, because I think a lot of people in the audience have a 401k or maybe an IRA or SEP IRA, which are all different types of retirement vehicles. The thought is, in terms of guarding against losses, is understanding that if I put my money into a 401k or a SEP or a SEP IRA, right? If I need to get that money out, right, for an emergent purpose, right? The thing I got to guard against is if I'm not of retirement age and if I don't have a qualified reason for taking that money out of the retirement account, I'm going to pay a penalty, typically a 10% penalty on that money in addition to taxes. Well, that 10% penalty eats away at the money that's in your investment and ultimately the money that's in your hand. That's a problem, right? And that's what you got to guard against. And that's why you want to make sure, did I plan well enough for this to make sure that I can work around this type of risk? Maybe I make sure that I have enough emergency cash to the side so that I don't have to dip into my 401k. That's an example. Another example deals with if you have investments that are in the market, right? And there's a bunch of gains, right? Thinking about whether or not I'm going to hold on to this investment for a year, 365 days or more. Because if I hold on to it for 365 days or less, it's subject to ordinary income tax, which can go from 0 up to 37%. But if it's long term, it goes from 0, meaning over 365 days, it goes from 0 to 20%. So a big difference, right? But that helps minimize the amount of money that you lose in terms of having to pay taxes. I've even had situations where clients have basically had no earned income, all investment income, long-term at that, and they end up having like a zero tax liability because when you have long-term investments and no active income, no other sources of income, you can potentially be in that position where you don't have a tax liability. And that's one way, as a side note, that's one way that some of our counterparts that have means and have monies in the market, a situation where they can pay a lower tax bill than those of us that may work a 9 to 5 or those of us that may have active income. So that's a thought there. But also the other thing to understand is if you're getting into these different types of investments, whether it's real estate, whether it's a business, or whether it's investments, the importance of being compliant with your taxes. The IRS is back on now, that the whole thing with the pandemic is past. So they are levying. So all of those things they will do if you're not compliant. So it's important that you file your return and that we pay our taxes. I've talked about being the imperfect CPA. I've talked about how I've owed taxes, how I've had to get into installment agreements, because if I don't do those things, and I've had liens put on because you owe tax, and if you owe over like $50,000, they'll put a lien on to protect their interest. The IRS will protect their interest by putting a lien on to make sure that they protect and get their money. Well, that lien, if you're dealing in real estate, can be problematic for folks. I've actually had clients who were trying to sell a property because there was a lien. That money had to come out of the transaction to pay the IRS before they got their money. That is a risk that you want to guard against. So you want to make sure that you are guarding against those things. And if you don't have a CPA, this is one very important reason you want to have a CPA if you're dealing with business or dealing with investments, because we can help with those kinds of things. Asset protection. So the importance of looking at structuring. How are my businesses structured? Because that plays into taxes. It also plays into legal liability. So let me put this disclaimer out that I did not put out before. I'm a CPA, but I'm not your CPA. So therefore, the information I'm presenting is only for educational purposes. I'm also not an attorney. I'm a CPA. So the things that I'm presenting, you need to talk to your attorney about to make sure that they are fit for your situation. And finally, let me also say that I'm not an investment advisor. This is for educational purposes only that we're presenting this information. Is you should seek out professional advice for the things that you're doing. So that said, asset protection, that's one very important reason that people use structures like limited liability companies, corporations, and partnerships, is to shelter or shield the owners and protect them from, if there are legal situations, whether or not their personal assets can be attached. Because again, we talked about guarding against losses. So you want to make sure that you are getting into the right type of legal structure. And most of the time I tell people that if they're in business, typically you need to be in some type of legal structure. I think, this is my personal opinion as a CPA, that sole proprietorships are like passe. There's no reason now, given how inexpensive it is to set up a limited liability company, how inexpensive it is to set up a corporation, how inexpensive it is to set up a partnership, that anybody should be doing business under their own individual name. I realize there are certain cases where professionals, sometimes they're limited in whether or not they can be shielded from liability in type of a corporate structure. Sometimes it applies to attorneys and doctors and such if the company's not set up a certain way. But in general, we should be under some type of legal structure, because that will protect and guard you against losses and separate your business assets from your personal assets. And the other thing is to make sure that when you're entering into contracts for whatever you're doing, that you are sure that you read the contract, number one. I've been guilty of this. I don't always read contracts unless I just sign them. But you should read the contract. And then two, depending on the size of the investment or what you're doing, make sure that you have an attorney review it to catch what you don't know, because you don't know everything. I, as a CPA, don't know everything. It's really important to have someone that knows more than you review those things in certain situations. And then cash flow management. So no matter what investments you're doing, a business, stocks, bonds, cryptocurrencies, real estate, you got to have some liquidity. If you don't have any liquidity, meaning cash in the bank, some cash that's not dedicated to any of these things, emergency cash, you're really putting everything that you have at risk, because at the point in time that you need cash, right, that's when you start to do things like sell off your real estate or sell off your investments, or do things that are going to encumber the business or the real estate, because you need that cash right away. But if you can manage your cash, one, by having an emergency fund, two, by making sure that you avoid things that put stress on your financial situation, and three, by managing your expenses, then you put yourself into a better position to be able to guard against losing what you got. And then Proverbs 11:14 says, where no counsel is, the people fall, but a multitude of counselors there is safety. This is probably one of my favorite scriptures in the Bible. There's safety in a multitude of counsel. So it's always good to seek out not just one person, but really multiple people, because they can confirm what another person is saying typically, and that's what provides the safety versus getting information from one person and not another. So sometimes I have clients that will come to me, and then I'll also go to their attorney to talk about things, for example, a legal structure, to make sure that they're getting the best information. But seek out wise counsel, whether there's other individuals that are in your circle that are doing well with their money. Ask them for advice and direction. Seek out a financial advisor, but have some counsel around you. And that's the really what I want to talk about on today. We need to protect this hard-earned money that we're working for, this money that we got working for us, that we've put to work, made our employee, against losses. So I want to encourage you to make sure that you employ the strategies that we've talked about today. I know I went through a lot of different things, and hopefully you took some notes on these things, but make sure you guard your treasures against losses. And next week, the plan is, I presented my budget over a month ago. So what I want to do periodically is present, this is what my budget was, this is what my spending was, and show how I balanced out. Because again, that's the other thing about having a budget. You can't just have a budget and not use it. You actually have to have the budget, look at it periodically, so you can make decisions that are best for you. So until next time, see you at the top. Thanks for joining us on today. Please like or subscribe to my YouTube page, Emax CPA. You can follow me on Instagram, Emax CPA, and of course on Facebook, where you're watching this right now. If that's where you're watching it, you can follow me there as well. And you can also visit my webpage, ericmcglothen.com, and look forward to my book coming out soon. I know I'm talking about it, but I'm almost there. Make Money Your Employee. So until next time, see you at the top. Thanks for joining.